This is our first session about the topic of using the cloud platform Wave Accounting for your small business. We're going to spend a little bit of time in this first session just introducing everyone to a little bit of accounting theory. It makes a lot of sense because we're going to very quickly transition into using the software. I'll be using terms that I really want to explain before I proceed to the next episode. So in this episode, bear with me, we're going to have a little bit of introduction to accounting theory. This is not your cup of tea, I understand. Just skip over to the next episode. But let's just explore for the next 10 minutes a little bit about accounting. Now, it doesn't matter what platform you're using, whether it's Wave Accounting, QuickBooks Accounting, Sage Accounting, it's the same for all, in that all of these software applications are using and working to provide information based on a set of rules, which we call bookkeeping practices. And so in this world, which is really founded at a time in which things were done by hand, there was an idea that came into being that as a first rule of checking for accuracy, whenever you're tackling a transaction, that two numbers are created. It's a bit of an odd idea, and most people struggle with it at first. But let's just accept the idea that every transaction, two numbers are created, one on the left, one on the right. And why do we do this? Well, when things were done in a manual basis, if you were writing a check for $1 and you put $1 in a book that was on the left side of your desk, and you put the same number in a book that was on the right side of your desk, then at the end of the day, you could add the columns of the two books. And if the two agreed with each other, then you had a first check of accuracy that you hadn't made a blatant mistake in terms of the information. So that was really the idea that was given to us over 2,000 years ago. And so as a result, we still work with this today. And even though we have beautiful application software like Wave Accounting, the fact of the matter is, underneath the hood, every time you enter a transaction, there's one number being put on the left and one number being put on the right, and that works its way into the formalized financial reports. Now, when we deal with these two numbers, one on the left, one on the right, which history has given to the words debit and credit, when you hear these words, at this stage, I just want to introduce to you that those words mean really essentially one thing. A number on the left side, that's a debit, and a number on the right side, that's a credit. Most people struggle with this at first, but this is the world of accounting, and this is how we go about doing our job. So we've learned so far, every transaction has two numbers, one on the left, one on the right, one on the right, and how do we use them? Well, in 1491, a mathematician based in Italy wrote really a document that became the Bible, if you will, for accounting. And it introduced an equation. And the equation is the fundamental bookkeeping equation, A equals L plus E. So let's just break this down. A is for assets. These are things that an organization owns. Assets are good. We love assets. The more assets an organization has, the better off it is. Then we have the letter L, which stands for liabilities. Liabilities are not so good. We don't like liabilities. This is monies that we owe. The more money we owe, the more trouble the organization's in. And then we have the third part, which is E for equity. Equity is an interesting one. Now I have on the screen here a bit of an illustration, and the illustration is A minus L equals E. So basically, if you take all the money in the bank, that's all you had, and you paid off all your bills, you would have equity. Or another way of saying this is what's left over for the owner. It doesn't matter who the owner is. It's a nonprofit, it's the membership, If it's a corporation, it's the shareholders. If it's a proprietorship, it's the owner. So that really is what equity is all about. It's what's left over for the owner after all the bills are paid. Very simple way to think about it, and a good way to think about it. Now with equity, remember that it really comes about through one of two ways. One, the owner puts money into the organization. If it's a nonprofit, members are buying memberships, that goes into equity. If it's a corporation, people are buying shares, which goes into the corporation. If it's a proprietorship, the owner just puts money in. There we are. So really, that's one way money gets into the equity section of your books. The other way is the organization has more revenues than it has expenses, creating what we like to refer to as accountants as profits. And so now those profits can be immediately given to the owners. There's nothing wrong with that. There's a thing called REITs that, a lot of shopping centers are owned by REITs, and they just basically send money as soon as they make it to their ownership. Or you can make a decision as the ownership to keep the money in the organization, help it grow, give it the ability to buy more assets, pay its bills. And so those profits that are retained lead to a concept of what is called retained earnings. So that really just simply breaks down how we deal with the debits and credits. And specifically, we take this formula, A equals L plus E. We now understand what each of those letters stand for. And we do a dividing line right here, a dividing line, and left of the dividing line are assets. So therefore, by definition, if a number on the left side is called a debit, then when we're improving assets, we're going to debit the asset account. The opposite of a debit is a credit. Perfect. In terms of liabilities, they're on the right side of the equation, aren't they? So as a result, when you owe money, you will credit the account, leading to the term that people that you owe money to are your creditors. Great way to remember that credits are assigned to liabilities, people that you owe money to. And E is what's left over after paying off all the liabilities. And you can see that there's two ways to get money into equity. Now at this stage, I just want to introduce to you what I call the first mantra. And the first mantra is just something you have to remember when you're doing bookkeeping or accounting. And we're going to just accept the mantra, expenses are always debits. Just say that to yourself. Expenses are always debits. There's in every discipline that you learn about, it's important to have a few of these mantras where you just remember through rote. And so I always have this first mantra, expenses are always debits. Expenses are always debits. So very good. And so we've got a good introduction as to how debits and credits are assigned. And we can spend the next few minutes just talking about the fact that there are things which are called accounting principles. I'm not going to spend a lot of time right now about this, but basically these are rules of the road, and we'll refer to it as we work our way through using wave accounting. But at this stage, it's just important to recognize that just like when we're driving a car and going on the road and there's a stop sign, there's a similar set of rules for bookkeepers and for accountants. And basically, finally, what we're doing is that we're working towards a finished product. And this can be deceptive because one of the great things about wave accounting is that as you enter data, you can run reports anytime you want, but that doesn't necessarily mean they're correct. So there is always a process by which you need to recognize that there's a finished product of what we do as bookkeepers and accountants. And this finished product is used by owners of the businesses, it's used by CRA for tax returns, So it's important. And basically, the finished product is two documents. Actually, there's three, but we'll focus on two: the balance sheet and the income statement. Basically, the balance sheet just lists at a point in time your assets, your liabilities, and equity. And basically, it'll tell you things like how much money you have in the bank, how much you owe to your creditors, and how much money is really there still in the business for the owner if should the business dissolve. And just as important is the income statement. And the income statement, what it does is tell you how you're doing within a period of time. Usually 1 year, can be a month, can be a quarter, but usually 1 year, about how much revenues the organization has captured and how many expenses it's paid out and whether or not there's a profit and loss. It's called all kinds of different titles. I prefer statement of profit and loss because it really tells you what it is, just like I prefer the term balance sheet. So the income statement is organized in a specific way. It tells you its revenues and it tells you where the expenses came from. And we will examine more about how these two groups work with each other as we go to the episodes to follow about wave accounting. And the balance sheet, again, is organized in a specific way. And we're not going to today spend a lot of time worrying about what these are all about, but I will be talking about it as we work through the wave accounting software. But basically, you should appreciate and understand that when you open a set of books in wave accounting, it is set up in a specific way for specific reasons. And basically, the simple process that we should be aware of, when we hear the word current, like a current asset, it means any asset that can be converted to cash within the next year. A current liability is something we have to pay within the next year. And then basically, once we understand those ideas, long-term assets like fixed assets are assets that you have for longer than 1 year and can't readily be converted to cash. Just like you may have a mortgage, it's a long-term obligation, it's a long-term liability because you can't pay it off immediately. You're not allowed to. You may be able to pay a little bit once each year, but you're not allowed to pay it off until the contract is fulfilled under the mortgage agreement. So really, that's just today my first little introduction to accounting theory. And it's important that we start to get familiar with these terms because as soon as we plunge into using wave accounting, we'll be using these phrases. So, you know, again, thank you for attending our session today. And I look forward to the next episode where we'll actually start the process of getting our wave accounting ledger up and running.